Welcome back and thank you so much for staying with us. Now, it is the second consecutive time now that consumers are taking another sigh of relief, this time for another next 2 months, as Bank of Namibia has decided to cut the repo rate by 25 basis points to 7.25%, with a prime lending rate at 11% for the next 2 months. Now, to discuss this and other aspects around the domestic economy, I am joined, that is via Zoom by economists Rodney Hoab, as well as in studio, that is by economist Klaus Schade. Good evening and welcome to Business Today, and thank you so much for making time for us.
Good evening, Ms. Navinda, and good evening to all our viewers.
All right. Good evening, Rodney.
Good evening, Adrina. How are you?
I'm very well, thank you. All right, let's perhaps start with you. What is your reaction on the reduction that is of the repo rate?
I believe it's widely perceived as a sign of relief by the nationals of Namibia, and then especially people who are benefiting from the banking services, especially housing or mortgage loans. And I think it is a sign of relief that is good even for the consumers in the broader ends of the economy. I think it's good for us.
All right. Mr. Schade, perhaps your sentiments on that as well, your reaction?
No, I fully agree with what Rodney said. I think it was expected. What I found also encouraging, like in August, that the Bank of Namibia took the initiative and proactively cut interest rates before the South African Reserve Bank cut the interest rate. The South African Reserve Bank followed in September and is going to have its monetary policy meeting next month in November. So we were not waiting for direction, let's say, from South Africa, but we took the first step. Even before the USA Federal Reserve Bank started their interest rate cutting cycle also in September. So we were proactive this time, and that is encouraging. Although I must say the nominal and in particular real interest rates are still at a very high level. They are at the highest levels for the past 15 years, and in May 2009 we had a nominal interest rate of 7.5%, but at that time inflation was 9.3%, so way higher than the interest rates. Now we are with an inflation rate of 3.4%, so the real interest rate, the interest rate adjusted for inflation, is much higher than we have seen in the past. For me, it indicates that there is still room for further downward adjustments.
All right. Now, Rodney, perhaps just talk to us about the broader impact that is of this reduction. What does it mean for the overall economy of the country?
In the sense, I believe also, if I just may touch on Klaus's point, this is a super cycle that is not very good for consumers, and it is not very good for people that are outside the financial space. I believe that it is more flourishing for the banking sector, and the super cycle was pretty much tracking from the years of 2022, from the COVID period, where we have seen the unprecedented rise of 7% in the interest rate. If we go back to 2016, it was around 6%, and around 2012, it was about 5.5%. What that adjustments needed to be done was, during the era where the US dollar was quite a bit lower on the side of 12 South African rand versus $1, we could experience that consumers had a more better environment that was more conducive for them to buy properties and to take loans from the bank or vehicle loans. But however, when you look throughout the years, you see quite a retraction in the demand for housing as well, because we need affordable housing and affordable land, which are some of the snowball effects of having a high inflation rate, is that you cannot cover for people that are in the middle classes. And I believe that the water that is filled in between, or the gap that is filled in between the high inflation rate that is rising and affordability of life, makes it very unbearable in the long run for people to really feel the impact of ease on the economy. We need to create more jobs in that sense, so that people can really feel the ease, or they can keep up with the rising trends. Because in the moment where we are, there's still people that are recovering from the post-COVID losses in terms of business and in terms of having employment or stable employment in that sense. And I believe that to close the gap, we need to do a more aggressive tactic, because I've seen that the effect on the GDP is that it has dropped. Actually, the year will not be the same as we expected on the previous footing that we were on last year. Last year, we were having about 4.3% in GDP growth, and then it reduced up around 3.5 on averaging in the first quarter during this year. That tells you that the broader impact is not yet felt. Therefore, I think we need to, rearrange our discussions around that point.
All right. Now, economist Schade, perhaps just take us through the two sides of how consumers are affected when the repo rate either actually decreases and reduces. Reduces and increases.
Okay. When the Bank of Namibia reduces the repo rate, then also the commercial bank usually follows relatively suit and reduce their interest rate. So let's say the money they charge on any loans that they have extended to the private sector. So if the interest rates are lower, then you pay less every month for your mortgage or for any overdraft and so on. But on the other hand, of course, those who are in the fortunate situation and have more savings than credit from the bank, they also receive lower returns on their savings. Right. But when you increase interest rates, then of course you have your borrowing costs increases and you have less disposable income, so less funds available that you can spend on foodstuff, clothing, entertainment, and so on and so forth. But it not only affects the consumer, but also businesses as well. And the higher the interest rates, the less likely is that businesses would take up loans from the banks to expand the businesses, because it's expensive and it might not be economically viable to borrow at these levels and expand your business. And it affects government as well, because the higher the interest rates, the higher the borrowing costs for government, and government would have less funds available for other essential services like education, health, and so on. So it really benefits the whole society, I would say, overall. It improves business confidence, consumer confidence, and hopefully we'll see that reflected not only in GDP growth, but in particular in employment creation.
All right. Perhaps let's shift our focus to foreign investment. How does this reduction of the repo rate influence, that is, the foreign investment into the country?
I would say foreign investment is usually depends on foreign borrowing to a large extent. But since I think globally we'll see a reduction in the interest rate level, it of course also let's say encourages foreign direct investment in the country. And then of course it depends on whether these foreign investors are focusing on the domestic and regional market or on other global markets. If they focus on the domestic market, then of course consumer confidence increases. So the business prospects for the foreign direct investment is better than in the case of a very high interest rate level.
All right. Now, Rodney, I believe you're still on the line with us.
Yes.
All right. Perhaps just talk to us, or rather talk to us about how likely is this repo rate reduction, of course, bringing relief to the cost of debts. And as it is now, things are getting cheaper, as mentioned earlier. Also, break it down for us what this means, that is actually for bank or rather bond repayment.
The bond repayment would be a little bit favorable, but consider that the prime rates, whenever it reaches the levels of prime plus 3, which is maybe 11%, a double interest rate is not really attractive to anybody. People want to be in a position where they have a single-digit prime plus rate, 9%, little bit around the margins of 8.5 or in that range. We were there during the time of the COVID pandemic, and I believe that it created that possibility amongst people to say that interest rates can really be lowered. If you look at the countries in the West, the interest rates are quite very low, and the lending rates are also lower, which even goes down up to the subprime level of below zero, and that tells you around 2%. That tells you that there can be a lot done in order to stimulate lending. If you want to stimulate lending, and I believe the Monetary Committee has also looked at the lending rate, and their concern was also that the uptake for loans is a bit weaker, has fallen little bit flat. And I believe that if they incentivize with a little bit of repo, hopefully in the next quarter we will see a little bit more a change in that. But I also want to touch a little bit on Klaus's point in terms of the production and the investment. Investors are more attracted to a weaker US dollars compared to the rand, which is currently the rand is a bit dominant. The past few months, it's 17.5, and I believe it deters the investments a little bit, but it's also good for the operational costs, or it's also good in terms of the profits that are realized locally, and then also it is cheaper to import at the moment. Nonetheless, that's why the import bill has also raised a little bit above 25 billion Namibian dollars. We have imported quite a lot in the past time. But touching on his point of the production price index, which is also one of the things that just ties along with the consumer price index, is growing in Namibia, because behind inflation, you have transport inflation, you have energy inflation, you have inflation tied to food and food items and so on. When that is high, it basically makes, like I said, the standard of living becomes higher, the purchasing power parity becomes high. And that I believe that when we weigh on those margins, we will not just celebrate, but we will really appeal a little bit more and see if we can win something. Because when economic growth is not favorable at the moment, it is. We need more incentives, and I believe the tax relief was one of them. And I believe that was a fiscal policy measure. And now we need to look at more the monetary policy, how it can be more relaxed to be in favor of everybody.
All right, now, Schade, you did mention a little bit on inflation. You did mention that it actually has gone down. Perhaps just take us through the factors that actually put that it's inflation down, and in the same breath, just give us your final remarks and roundup of this specific topic where the Bank of Namibia has announced that it's a reduction of the repo rate.
Yeah, the main drivers of inflation in the past were transport inflation, oil prices, and because of the relatively weak Namibia dollar for quite some months against the US dollar, fuel prices were quite high and had to be increased in the country. So that drove inflation up, as well as food prices. And since we are a net food importing country, so we rely on the world markets, and these are two factors that are actually beyond our control and therefore not really influenced by our interest rates. And oil prices have not just stabilized, but have come down in the past couple of weeks, and with a strengthening Namibia dollar, so it has a very positive impact on fuel prices and therefore transport inflation. Transport inflation was just 1.2%, I believe, in September. So one of the lowest price increases over the past months. So that was the main driver for bringing inflation down to 3.4%. But food prices or food price inflation remains quite high, 5.1, 5.2%. And this food price inflation affects in particular the less fortunate, the less privileged, because they spend a much higher share of their total consumption on food. So they are very much or much more affected by higher food prices than the better off. So that remains of concern. And again, with these extreme weather events globally, we'll probably need to get used to relatively volatile food prices, because it's beyond our control. We are not self-sufficient in food. So therefore, there might be still some inflationary pressure. But again, the Bank of Namibia, I believe, is more concerned with maintaining the peg to the South African rand and the South African, the South African rand and the South African Reserve Bank. They have an inflation target of between 3 and 6%. It's currently, or it was 4.4% inflation in August. We expect the next inflation for September, I think tomorrow or the next couple of days. So we will know much better whether inflation dropped by the same extent as in Namibia, and that will certainly impact on their monetary policy decision. But I wouldn't be surprised if the South African Reserve Bank takes a bit more aggressive stance and reduces the interest rate by 50 basis points next month, which would be good for Namibia as well, because it provides also more room for this Bank of Namibia to reduce interest rates further.
All right. Rodney Hoab, perhaps in brief, just your final remarks on this repo rate reduction.
I believe it's a wonderful sign of a inflationary or a economic expansion that we may realize, especially when we come into the critical quarters of the year. We want to witness something that can spell a sign of optimism for 2025, and I believe this is a good start. If we look at the global forces, the geopolitical landscape, although this one was flagged as the year where 50 countries were going into elections, and then we have got a little bit of some tensions that are also happening, especially in the Middle Eastern areas, and then which may also subsequently affect the oil futures. I may say that let's brace ourselves, because the climatic conditions are also not very much in favor of us, but regardless. And I believe that this is the time that we look at other instruments that can basically sustain the economies in order to evade the consequential effects of the economic onslaughts that may happen. And I believe that in that sense that we have to, pull our socks up, especially in the third and fourth quarter of the year that is coming up. And we believe that if the Christmas spending, if the economic booms in the fourth quarter, if they are marginally very favorable to the emerging and developing economies like Namibia, which pretty much depends highly on customs revenues, on duties, and especially on taxation, I believe that we may witness something that can stabilize us until we see the next rainy seasons. And like Klaus has mentioned, we may become a little bit food sufficient. And I believe that let's just try to balance the effect of too much imports that we may bring into the country. And also, one of the things I haven't mentioned is that one of the key factors for the slowdown in the economy is because of our resource and extraction sectors, the diamond industry, and all the sectors that are being affected at the moment, except for the gold sector. I believe that we need to little bit have a more prudent approach in avoiding a next budget deficit, which can happen and which is very much likely. If a budget deficit is rolled in at the moment, it can catch us off guard, because even though government wants to improve their spending, but repayment of such debts and loans will come at a very high cost in this climate, especially. Thank you.
All right, gentlemen, thank you so much for making time for us here in business today. And of course, we'd like to speak to you more, but unfortunately, time is against us this evening. Now, that was economist Rodney Hoab as well as Klaus Schade discussing Bank of Namibia's decision that is to cut the repo rate by 25 basis points to 7.25% with a prime lending rate that is at 11% for the next 2 months. Now, that also brings us to the end of tonight's edition of Business Today. Thank you so much for tuning in. And of course, do catch us again on Friday for more business news affecting the economy and of course, your pocket. From me, Erica Nawinda, and the rest of the team here in Studio 3. It's good night.